Hello and welcome back. Today we are diving into a situation that gives every single investor nightmares, a market that's falling and falling fast. But here's a thought. What if you could actually turn that panic into a plan? We're going to break down exactly how to manage your portfolio when everything seems to be going south.
And really, it all boils down to this one question, doesn't it? When you see those numbers dropping, is it a crisis that makes you want to hide, or is it an opportunity in disguise? Believe me, the answer you choose can make all the difference in the world to your portfolio's future. All right, so here's how we're going to tackle this. First, we'll look at that classic investor dilemma. Then we'll explore path one, which is just doing nothing. After that, we'll introduce a pretty cool strategic alternative, see it in action, put the two head-to-head, and finally, we'll unpack why this second strategy is just so powerful.
So let's set the scene. You've got your portfolio, you're feeling good about it, and then the market starts to turn. As those green numbers turn red, that gut feeling, that fear kicks in. And for most people, the instinct is to just freeze up, totally paralyzed, terrified of making the wrong move.
So let's go down that first path, the most common one. What actually happens if you just do nothing? You know, the old wait and hope approach. This is going to be our baseline, what we compare everything else against.
Let's keep the math super simple. Imagine you invest 100 rupees when the market is at a level of 100. Then, things take a turn and the market drops all the way down to what we'll call a worst-case level of 76. If you didn't touch anything, your portfolio's value just follows the market right down to 76 rupees. Simple as that.
And that drop? That's a 24% loss on paper. Ouch. That's a tough number to look at, and it puts you in a pretty deep hole right from the get-go.
Now this is where the really brutal math of a downturn kicks in. See, to get back to your original 100 rupees, the market doesn't just need to go up 24%. No, from that new low of 76, it now needs to climb almost 32% just to get you back to where you started. That's a much steeper hill to climb.
Okay, but what if there's a totally different way to play this? Instead of freezing with fear, what if you had a plan laid out before the storm even hit? Well, that's where a disciplined tool like this three-stage capital deployment grid comes in.
The big idea behind this is something called drawdown averaging. Now, that sounds complicated, but it's not. It's just a structured way of buying more of an asset as its price gets cheaper. You're basically turning a scary market drop into a planned, systematic buying opportunity. What's so great about a grid is that it takes your emotions completely out of the equation. You decide your moves in advance. So for our plan, we've picked 3 levels to act. A first buy at 83, another at 80, and then our biggest move is saved for level 76, the point where everyone else is probably panicking the most.
All right, let's put this plan to work and see exactly how it plays out. We've got our initial investment, and let's assume we have another 100 rupees in cash on the side, just waiting to be deployed according to our grid.
Here is our game plan. The market hits 83, boom, we invest 25 rupees. It drops further to 80, okay, we put in another slightly bigger chunk of 35 rupees. And then at the point of what feels like maximum pain, level 76, we deploy our biggest weapon, the final 40 rupees. And this is where the magic happens. Look at what it does to our buying power. That first 100 rupees bought us one single unit. But as the price drops, our money starts working harder and harder. That last 40 rupee investment at level 76, it's our most powerful move, buying us more than half a unit by itself. And here is the grand finale of all that buying. By investing a total of 200 rupees, we've now lowered our average cost per unit all the way down from 100 to just 88.3. This number right here is the key that unlocks the entire strategy. It changes everything.
All right, it's time for the main event. Let's put these two strategies side by side, the do-nothing approach versus our strategic grid. Let's see who comes out on top when the market is at its absolute worst. Look at that difference. At the market's low point of 76, the no-action portfolio is down a painful 24%. But our grid portfolio, it's only down 14%. That is a massive difference. We've essentially created a 10-point cushion, cutting our paper loss almost in half.
And this visualizes the real game changer. I mean, this is the whole point. Remember that grueling 31.6% climb the no-action portfolio needed just to break even? Well, because we lowered our average cost, our grid portfolio now needs only a 16.2% gain to get back in the black. The path to recovery is literally twice as easy.
Now, let's be totally transparent about the trade-off here. You'll notice the absolute loss in rupees is a little bit higher with the grid, 28 rupees versus 24. And that's fair.
But think of that extra 4 rupees as the price of admission. It's the cost of executing a strategy that got us more assets on sale, slashed our percentage drawdown, and made our recovery so much faster. It's a trade-off I think most people would take.
So to wrap things up, let's just quickly go over why this grid approach works so well. What's the core logic that makes this something the pros would use?
At its heart, it's just a smarter system. It gets rid of the need to perfectly time the bottom, which is basically impossible. It forces you to act progressively, and more importantly, it makes you deploy your biggest chunk of cash when things feel the most terrifying. It's all about having discipline and a plan when your emotions are screaming at you to do the opposite.
Look, at the end of the day, we can never know for sure what the market is going to do next. It will always be uncertain. But our response to that uncertainty doesn't have to be. Having a plan like this doesn't remove the risk, but it does help you manage it. It turns fear into a clear, structured opportunity. So the real question you have to ask yourself is, when the next storm comes, will you have a plan?